All right, we're going to kick it off, guys. So this is Contested M&A. I've got Bruce Goldfarb, who's President and CEO of Okapi Partners, Chris Young, who's Global Head of Contested Situations at Jefferies, and our friend Keith Rosenblum, who's the founder of Cruiser Capital. I'm going to kick this off with Chris because we kind of named this panel after your title, Chris. So this is your specialty. What's the classic form of contested M&A we see? And maybe it would be fun if you could give us an example of the situation you were involved in with Michael Dell and the take private of Dell with Silver Lake.
Great, and thank you for having me here today. The Dell situation's a bit dated, but I think we chose it because it covers many issues around contested M&A. For those of you who don't remember, back in 2013, Michael Dell and Silver Lake made an offer or agreed to take Dell private. His rationale was that he needed to transform a PC manufacturer into an enterprise solutions company that public markets would not withstand that sort of transition and the debt that would be required, et cetera. And almost immediately, we're seeing more of this now. And I read an interesting piece the other day about multiple shareholders going public against an agreed transaction. So this is not hostile. This is an agreed transaction. The company formed a special committee populated by independent directors. They ran a go shop. But what happened was a slew of investors, Southeastern Asset Management came out and aligned itself with Carl Icahn, T. Rowe Price, and Pazina, and the list goes on. And they were all public. And several of them proposed alternative transactions. Icahn proposed the leverage recap. Which was, a non-starter because, that would just be taking on debt, and what they were trying to do was go public so they could go private so they could take on debt to do that transformation. ISS and Glass Lewis, voted in favor of the deal. I brought Michael down to ISS and, prepped him on that. He rented the whole hotel right next to ISS, the entire hotel because of security concerns, and basically we at the end of the day we got to the meeting and we had to adjourn twice, and the issue was that there were a bunch of shareholders because the record date and Bruce's master at this, the record date was too far in the past, and so there were a lot of holders of record that could not vote their shares, or they could vote their shares, but they didn't care. And then the people that bought their shares couldn't vote because they weren't record holders. And so those shares were non-votes and or abstentions. And one of the things that you do when a company is being taken private by a founder is you usually make the vote subject to a majority of the minority, or majority of the disinterested shareholders. In this case, Michael owned 13% of the company, and so we just couldn't get the vote in, not necessarily because there was enough opposition. In fact, there were more people that voted in favor of it than they voted against it. So it was this technical issue. So in return for bumping or about 2%, 1.7%. We got that vote standard changed, which upset some people. But as ISS, Chris Ernst said at the time, if you're against the deal, you still can vote against it, but vote. Just not voting or abstaining is, not the right way to go about it. Also interesting here was BlackRock, the big three, BlackRock, Vanguard, State Street. They all voted against the take private, which is kind of rare for them. And then interestingly, because we could follow the vote, they all flipped to 4 within a minute of each other. And I'm just wondering if they talked to each other. I've got a theory that I have no evidence for, but T. Rowe Price, was a big agitator against it. And I see them together at a lot of conferences. And I think once T. Rowe gave him a call and said we were going to support it, the other side, the big three flipped, even though they're passive and they had no real opinion about what was going on. And so we got it across, but why such a, and we see it all the time with take privates, especially with founders, right? It's the asymmetry of information. Insiders, of course, know a lot more than outside shareholders. It's the potential for conflicts. It's also for public company investors. I've heard even from PMs at Fidelity, et cetera, they call it the inventory problem. They don't want a public company taken out of the universe where they can invest in. They need to find a place to put those proceeds. So all of those come into play. And, ultimately, postscript, we got the deal over the line. 2 years or 3 years later, a private Dell bought EMC after Elliott pressured them. And the largest pure tech M&A, I think still to this day, is $66 billion deal, $70 billion deal. But they took on a ton of debt to do that. And it's a good, so could they have done that if they remained public?
Chris, can I take you back a minute? Because one of the issues that you raise is how the public now deals with these things. And as a winner, but a net loser on a couple of those situations, now that the M&A rules have changed, once an inside deal gets announced, if the ARBs jump in, stock's at 10, and the deal's going to be take private at 15, and making all these things up, then if 51% of the shares trade hands in the next 2 days, you've lost. You've lost. You get squeezed out and it's done. And so incentives really matter so much, right? I mean, if you got a golden parachute in there.
I should have mentioned also we got to reset the record date. And by resetting the record date, we allowed all the ARBs that had bought the stock that wanted to see the stock.
Good tactic. Good tactic.
So,
I mean, if you're working for the company, good tactic. As a shareholder, it's very frustrating.
Oh, sure. I'm sure. And then I want one more postscript. Dell went public again 2 years after that. They were only private for 5 years. And so they went from a company that was, I think, what was it? It went up fivefold. I mean, it's worth.
The chart looks like Bitcoin.
It's a $135 billion market cap company now. The price, yes, they bought EMC, but the price of the stock, went from, I think 24 to 135, and Michael went from 13% ownership, and now he currently owns 46%, and he owns 70% of the vote. So a good deal for the founder there.
Nice. Keith, I want to ask you about, I want to get back to what you just touched on as far as the ARBs and stuff. But if I might, Keith, a source told me your fund's up over 40% this year. Tell us a little bit about what's been driving that. Could it be those investment ideas that you mentioned a year ago here?
All right. So in one fell swoop, you are challenging me on marketing rules, which I will not violate. And
trying to be nice.
And you are advertising your own conference, if I'm correct. So let me unpack the question. Yes, I'm very proud of our team this year. And B, the two ideas that were unveiled at your conference last year have been incredible performers. We talked about FTAI at $44 perhaps. It's $160 today. So that's a good return. And we talked about CRH at about 56, and I think it is at 99 today. So yes, good memory, good advertising. And was there another question in there?
Yes. All right. No. Let's get back to the panel topic. So couldn't resist.
Not really sure what to do with that one.
So the situation that you just described reminds me of one that I looked at and wrote about earlier this year, Abcam. And I sent you guys that article this morning. Whether you followed that one closely or not, we've seen this pattern before. You have a deal announced, and in this case, it was wild because even the company's own projections suggested that the price should have been much higher than it was. The buyer had lower projections, but I presume the reason that got done, well, a couple things. ISS approved it, and maybe Chris has some insight on that and why that happened, even though it looked like, I looked at it as a journalist objectively. From all counts, it looked like it was undervalued, but the deal got done. And then I imagine there was an ARB situation. Chris, tell us about how ISS looks at that stuff.
Well, I didn't read ISS's report on that deal, but I can talk to how I think they should have looked at it the way I looked at it when I started the special situations team there. I saw all the time, you could see a company that, when they were public, were blowing trumpets and putting out aggressive projections, guiding the street higher, and then suddenly things change a little bit and they decide to go private, and suddenly everything is dire and the sky is falling. It almost happens overnight. And I used to call companies to account on that. I'm like, what happened? You were just you're just projecting this EBITDA margin or this growth rate, and now you've cut it way back to justify the low ball price. I think ISS should continue to do that. I haven't seen their report and why they supported it.
Okay, yeah, Bruce.
Yeah, I don't want to talk directly about that situation.
But generally,
in general, what you do find, especially with the going private transactions, is that there's going to be some valuation that the investors who hold shares of the public company will largely say, the company's worth more than what the bidder is offering to pay.
Yeah.
And that tension is what leads to so many of these transactions becoming contested, not necessarily all the time an actual proxy contest, meaning that a third party files proxy material to vote against the deal. It just becomes a disagreement within the public markets and within the media. And so an ISS has to navigate what point of view is right or wrong. And that's what we're seeing here. We saw that. We worked on a campaign this year for Avangrid, which was taken private by Iberdrola, which was really the majority owner. So there was a majority of the minority vote. There may have been some rumblings of discontent about the transaction, but nobody publicly filed material, although Gabelli put out a tweet that said he didn't like the deal. And so there was no other actual bid out there. There was no other offer on the table. And the projections and what you could see in the proxy material said, this seems reasonable. You had bankers giving fairness opinions. ISS in that campaign didn't really challenge the deal. I'll contrast that with a situation this year where we worked for Permira, where they were buying Squarespace, and that was a public offering. They were going to go to a vote. The team at ISS in that instance had a deck of material from third-party Glazer Capital. There were other investors who were opposed to the transaction, and it became somewhat clear that the deal might not get done, especially if ISS was going to vote against it. ISS came out with a negative recommendation, and they certainly were very sharp in the questions that they asked. They asked about the valuation. They put the bankers on the spot. They put the company on the spot, where the company was talking down performance after they'd been talking up performance going into the potential transaction, and where the competitors in the market were performing wildly better with a thought process that, well, maybe the lag on shares at this point is because of the bid setting a ceiling.
Yeah.
Ultimately, in that campaign, Permira said, well, there's a lot of obstacle to getting a shareholder vote, but they did figure out there is a price that would clear the shares, and they went and did a tender offer. And so the process, that's the rule change that you're thinking of, but it's not necessarily, that's a rule change in how the tender offer works. And ultimately, there are more tools to address the issues that come up in contested M&A. Certainly since the Dell campaign, we worked for Silver Lake on that transaction, and we had to reach out to certain investors who could have voted but weren't voting. And in some instances say, you have the right to vote. Can you do us a favor here? I mean, that was kind of the level that you saw. Ultimately now, what we see is you do rethink the record date a little more. When you announce a deal, you're almost setting what I'll call rolling record dates. so that you have record dates set up almost every 2 weeks as you're moving toward a transaction to give yourself more optionality for when you ultimately set the date, and you're looking at the shareholder base and how they turn over as the deal's in review at the SEC before you move forward. So there's just a lot that changes over time that makes this all really interesting.
And Delaware requires you to move it up after 60 days, right?
Yeah, that's right. I mean, if Delaware law, if you don't have your meeting by 60 days from the record date, you're going to have to reset your record date.
Great. Now, just getting back to this idea of this essentially becoming a fait accompli once the ARBs get in, that seems just wrong to me. But now, it's not like a board can do this with impunity, right? I mean, I'm dating myself with Starboard and Darden 10 years ago. I mean, everybody got kicked out because they did that dumb deal, right? And yet, I don't see that kind of fear among boards these days. I mean, have the tides shifted or something? I mean, you see what I'm driving at? I mean, can you do something that's obviously not? Let's say Keith is a value oriented shareholder. He sees a deal get done. He moans about it, but they do it anyway. I mean, what happens then? Are the odds of those guys getting kicked out significant?
Sorry, when you say kicked out, you mean the deal canceling or the board or the CEO getting kicked out?
Yeah, the board, the CEO or director is getting replaced at the next meeting or sooner or whatever.
This has been a hot button of mine, maybe of all of ours, for a long time, which is, and I could cite numerous examples of where, CEOs are convinced by bankers to make very large stretch acquisitions, which do not work, which destroy tremendous amounts of shareholder value, and there are no repercussions. I can give you two off top of mind. One is very recent, which is Celanese, which paid more for a division of DuPont than DuPont had said that division was worth. And Celanese spiked up for a day, and I think it's gone from 176 to 75, pardon me, in value. I can think of Chart Systems 2 years ago was trading at $212. They announced an acquisition of a company held by a PE firm down here, and literally 2 days later, the stock was cut in half. It was 110. And, there's no repercussions. So I think that it's a different topic, but I think the issue of education of boards and directors, specifically as to what creates shareholder value versus what is quote unquote good governance, is a really important distinction. It is very frustrating to me that the majority of boards in this country are populated by people with very little financial literacy. Chris and Bruce can both speak to this. It is extremely frustrating that you have people making important financial decisions about capital allocations, and they really do not have the skill set to evaluate what the impact on the overall enterprise value is. And unfortunately, we see it every single day. So there's nothing to say, but thank goodness you have contested proxies to give the shareholders at least a voice.
You don't think that a terrible acquisition opens the door for someone like you or an activist to come in and
look,
get board representation?
Here's the reality on that, Chris, because yes, it does, but here's the thing, and you can talk to any activist investor about this. No one wants to put the money and time to turn around a business unless it's a really good business. And in both the examples I just cited, those businesses took a pristine balance sheet and levered it up so much to basically be sold a bill of goods by someone, no doubt, who has a beautiful home on Palm Beach Island. And they've now levered up so much that they've really impaired the integrity of the business. So now you have to think twice. Do I want to get stuck in this business just because I want to change out the board? So, but yes, overall, perhaps, but I don't think that's a productive way to move
the company.
Yeah.
Not if they ruin the company.
Yeah, not if you're ruining the company.
And that's part of the point, that an activist is looking to enhance value at the company. And a company that looks to become so broken through an acquisition, you can get mad, you can get yourself onto the board, but Right. I mean, that's what like Johnny used to call the value trap. Right. You know,
Right.
That's what you don't want to do, and that's bad activism. Good activism. Unfortunately, we're going to see fewer campaigns like Darden, and that's structural. Partly it's because Starboard did it, and boards and companies got smarter about how to defend themselves, and now we have universal proxy card, where it makes it, in some cases, easier to get board representation, but much harder to get a majority.
Can I ask a question of you and the two of them?
Yeah,
Bruce. So this is the corporate governance conference.
Yeah.
So, there is a reputation of activists writ large as being the barbarians at the gate, or the pirates, or the raiders, or whatever stupid terminology people want to use. But I am curious, because at the most fundamental level, particularly with small cap companies, you've got people who are using their own money, their own time, to do one thing, right? Which is create more value for everyone, right? So I'm just curious, in your experience, are activists positive for change? Are they positive catalysts for change? Or are they negative catalysts for change?
Well, I think
You've covered a lot.
I
What do you
think they're clearly a positive in most cases. I think that, as Bruce alluded to, there are some situations where it's, the campaign is misguided, but I think in general, you're right. I mean, look, when I was doing more writing all the time, I would always give my ear to investors because they had skin in the game, right? I would be much more interested in talking to someone who was long or short of stock than anybody else, much more than the sell-side analyst. Doesn't matter how good their work was. To me, that was important. I hope that's a good answer. I mean, if you're trying to make money and you're not good doing it right, I would say that's...
There isn't a bad answer, except that Chris probably can't answer because it hits his customer.
Well, I'll let you answer, because I'm very curious to know. But the reality is, of course, there are some bad activists.
Fair enough.
But for the most part, activism is rooted in research and thought about the company. It's people whose living is made in ways to enhance the value of investments for their own shareholders. And you see, one of the reasons for me that we see so many settlements now is because management teams and boards have come to accept that there are other ways to enhance value, and having a proxy fight is not necessarily going to be value additive, except maybe for people like me. But at the end of the day, peace can break out all over because the activist has done the hard work that can help create that value.
Yeah, I would agree with everything you guys said. I've been advising on activism for 20 years, so I've seen a lot of shifts over that time. So early days, everybody wanted to batten down the hatches. Every activist was evil. Every activist didn't know what they were talking about. Every activist was disruptive and couldn't add value. I'd say when I go in front of boards now, a majority are open-minded about listening and engaging, and not just going through kabuki theater, but engaging with an activist and considering putting people on. And that's what, to your point, Bruce, those are the settlements. You'll get directors on, like I think we should, like getting in arguments with other directors, which you never had before, saying, these guys have a significant position in our company, and we should listen to them. And we've looked at some of their prior campaigns, and they've added value. The shares have gone up, but it's very fact and circumstance dependent, right? Depends on the activist, depends on the target.
Now, Keith, something else that you said in the past is that when there's a company that's, let's say it's not widely followed, very little sell-side coverage, you're a shareholder. You don't even need to be a big one, but you care about the company, you've been following it, and you got some ideas. I think you described that as a gift to the company. I know I'm not being silly with this. I mean, let's just, for argument's sake, say it is a gift. It probably is. I mean, Keith's a smart guy. He's not going in there to run the company to the ground. So, but how do they look at it? In what cases is it not seen as a gift? Should I put it that way? Maybe sure. After they've already made a bad decision or they've announced a deal, they're probably not as likely to listen to you then. Well, do you tell me?
well, just really quickly, to stay in compliance with the marketing rule, and my kids will be watching this later, I'm sure. You've complimented me way too many times. We make a ton of mistakes. We have had many losing investments as well. So, look, I think it is a gift, and I've had that discussion many times. I recall a very specific situation where that was the exact conversation. The CEO of Ashland, we gave him a former CEO of Sealed Air, who was an incredibly popular and accomplished executive. He said, "What am I supposed to tell everybody when we signed the settlement?" And I said, "Tell them that one of your shareholders gave you a gift." He didn't choose to use that line, but it was true. And in my view, a lot of the problems here is ego. You have to be able to check your ego at the door. And the reality is, companies are often complex entities.
Yeah.
And when companies move on in their life over 3 or 4 or 5, 10 years, particularly after an acquisition, some things get forgotten about. And integration, and like Chris was talking about, when you've promised certain sets of projections and they don't come to fruition.
Yeah.
Right? It is a very fair question to ask why that didn't happen. And if something different had happened, could there have been a different result? And why were decisions made? These are fair questions. And if you think about the way annual meetings used to be, right, versus the way annual meetings are today, you would have shareholders in a room, For those of you behind the camera, there are thousands of people in this room. Mm-hmm. And you would have lots and lots of people, and everyone would be entitled to ask a question, and they would go. Not everything was like the Berkshire Hathaway meeting where it would last a whole day, but you were able to interact with management, and you were able to challenge them and get real answers to questions. That's not the way it is now. Annual meetings are effectively performative. It's some of them are over in 3 minutes. And
it's interesting.
Sometimes they're pre-recorded.
Yeah, exactly. And sometimes they're pre-recorded. And so shareholders do not get even that one day as an opportunity to speak to management. And yet, everyone makes mistakes. It's just life, Everything could be different. And when somebody who thinks hard about your business, and just think about your business, doesn't need to be a large public company. If somebody says something about your business that could potentially be constructive, you probably owe a duty to yourself and your shareholders and all of your stakeholders to consider it. And that, to me, is, I think, the essence of dialogue and the essence of how, companies can move forward, particularly with their shareholders.
Yeah, that makes a lot of sense. Folks, we're almost out of time. Are there any questions in the audience here? Yes.
Can I get each person's favorite book on this topic?
Favorite book?
Barbarians of the Gate.
It probably was Barbarians at the Gate.
I was going to say the same thing.
No, I don't agree with that at all. I think there are. I highly recommend the Joel Greenblatt wrote 3 books. I would say all 3 of them speak to this issue. I helped teach a class at UConn's business school on how positive corporate governance impacts shareholder value. I'm trying to think of some books off that syllabus. There was a professor at UCLA Anderson School named Alfred Osborne who's written extensively on this topic. I think he's great. Anyway, but I think the Joel Greenblatt books are great.
I would say something on that. Actually, it's an interesting question, but I think that corporate governance, at least in the U.S., is so dynamic and fast changing. It's not like you can point to a book that's very old, because it wouldn't reflect some of the things that we talked about even 10 years ago, right? But with other countries like Japan, maybe, I don't know that it's changed tremendously. It hasn't changed as much as we have in the last 20 or 30 years. So the stuff that I was learning in college 22 years ago, might still have been effective. It's not exactly what you were asking. Yeah, right. Well, no. I mean,
I'll give you another great fun read. It's very quick, which is David Einhorn's "Fooling Some of the People All the Time," and I thought that was. I think it's still relevant today, as it was in 2013 or 14 when it was published. You're welcome.
All right, let's keep moving here, guys. Please find these folks at the reception tonight if you've got any more questions. I'm sure they'd be happy to talk. We got 2 more panels to go, guys. Thank you so much.
Thank you.